Good morning, everybody. This is Andrew Findlay from Antipodes Partners in Sydney speaking. Welcome to this quarterly call for New Zealand investors and clients of Antipodes Partners. I'm joined here by Alison Savas, the Client Portfolio Manager at Antipodes Partners. Also on the line is David Batty from our distribution partner Pinnacle, based in New Zealand. We have around 30 minutes today, including sufficient time for your questions. To give you an update on our portfolios. I'll just kick off first with a few introductory comments, and Alison will then take over and run you through a more detailed portfolio update. Hopefully you can all see these slides on the webinar. If there's any issue obtaining access to those slides, please ask either us directly here, email us, or David Batty, I'm sure, would be delighted to help as well. For information more generally about Antipodes and our range of PI funds, please have a look at antipodespartners.com/PI, and there's sufficient information there. Right, just before we get into the portfolio, I just wanted to say clearly New Zealand is an important market for us. We intend to host webinars like this on a quarterly basis to complement our face-to-face visits to New Zealand a few times per year. Excuse me. As a business, we are coming up on 4 years old. We're now a team of 25, 24 of which are investment professionals. And as you would have seen in the most recent period, it's been a very tough couple of months for us. I mean, as at the end of December, since inception, the underlying strategies have done very well relative to benchmark in an absolute term since inception. And the first quarter of this year really has been a very tough period as markets have very strongly rebounded, which Alison will go to in a minute. Suffice to say, the team is working extremely hard through these choppy markets, and we can maybe return to this in question time, but we are confident that our strategy, in particular the long-short strategy that most of you will be familiar with its embedded insurance, courtesy of the lower net position and its value style, will deliver for you and your clients over the cycle. I think it's the journey that is important. Clearly, in the short term, we haven't done as well as we would have liked, but obviously your investment timeframes, your clients' investment timeframes are much longer than a quarter, and we think we've got the toolkit, the resources, and the skills and experience on the team to do well over the cycle. So with that, I'll hand over to Alison to talk specifically about the portfolio as such. We'll talk about 15 minutes or so and leave plenty of time to address your questions.
Thanks, Andrew, and welcome to everyone who's joined us today. Before we get into a discussion about performance, outlook and positioning, I thought we'd start with a brief overview of who Antipodes is and what we do. Antipodes is a pragmatic value manager. So a typical value manager will wed to low multiple stocks with an expectation of mean reversion. We think this approach could miss structural change in an industry, and therefore you risk being stuck with the classic value trap. At Antipodes, we seek to own good quality businesses with multiple ways of winning, but importantly, buy them at the right price. Now, bringing this together is portfolio construction. Many managers will say they own 60 or 70 stocks across a variety of sectors, and so they are diversified. This misses the degree of correlation between individual names, and you won't realise how correlated they are until it's too late. Instead, at Antipodes, we think about our portfolio as a series of clusters. We seek diversification between the clusters to generate uncorrelated sources of alpha, and we limit the size of each cluster to minimise our exposure to unforeseen risk. What we end up with is an eclectic portfolio which won't look like the benchmark and won't look like our peers, but seeks to generate returns in excess of the benchmark over a 3 to 5 year period with below market levels of risk. So the role of the Antipodes Global Long-Short Fund in a client's portfolio is to provide exposure to global equities, but with the lower levels of risk through the cycle. So a lower net invested position can mean that at times the shorts may act as a headwind, particularly in strong upward moving markets. However, the purpose of the shorts is to provide protection and act as a dampener in times of market volatility and drawdowns. And we saw this in the fourth quarter of 2018. Global growth was slowing, credit spreads widening, and volatility picked up, and the market was down almost 14% over the quarter in New Zealand dollar terms. Now, our shorts generated 4.5% return in fourth quarter 18 and helped the global long-short portfolio generate 3% alpha in that quarter. Now, over the past 12 months, cyclicals have underperformed as concerns around tighter monetary policy have gripped markets, compounded by protectionist and populist rhetoric. So while the global fund has lagged the benchmark for the last 12 months, the underperformance occurred in the first 3 months of the year. So it's helpful to think about returns in the context of calendar 2018 and then year to date. So in calendar 2018, the global fund fell 2% in New Zealand dollar terms, while the benchmark fell 3%. So this alpha of 1% was driven by the currency and the shorts, and they were the key contributors when volatility emerged in the fourth quarter. Now turning to 2019, the global long-short fund has generated a return just over 7% year to date in New Zealand dollar terms, but has lagged the rally in global equities. So with the market up 17%, the shorts have been a drag, which can be expected in a strong upward moving market. The US stock market is up around 20% in New Zealand dollar terms from when it bottomed on Christmas Eve last year. So our underweight positioning in the US has been a drag on performance. The part of the US market that we are underweight is domestic-facing US businesses because they are expensive, having already had the benefit of stimulus. Now, with policy turning more dovish at the beginning of the year, investors have crowded back into growth, and it's been irrespective of price or balance sheet quality. So stocks where the market has very high expectations of forward sales growth have outperformed year to date. Many of these companies have structurally weak business models and yet are still priced to perfection. So some of our shorts are in this space. But remember that these stocks were hit the hardest in the fourth quarter, which is when we generated alpha, but have subsequently rebounded the hardest when policy turned dovish. Now, in terms of what has contributed to our performance, in terms of the portfolio being up 7% and the long book being up almost 13%, Qualcomm has been a key contributor for the fund year to date, as the share price responded to the favourable resolution of the licensing dispute with Apple. Now, this is a testament to the strength of Qualcomm's intellectual property, and a fact we have appreciated for some time now as we make this technology leap to 5G. Now, recent stock price performance of Qualcomm has been volatile as we await the Federal Trade Commission's decision on licensing practices, as well as broader concerns on the sector with the recent escalation in trade. But despite this, Qualcomm is cheap relative to rapidly expanding opportunities in connectivity, whether that be 5G, autonomous driving, the Internet of Things, and virtual reality applications. Our Chinese exposures, including Ping An and JD, have performed well, responding to Chinese stimulus policies. And our software incumbent cluster, which includes Microsoft, Cisco, and more recently SAP, continues to contribute to performance following strong results thanks to corporate IT spending and favourable product cycles. The next question is, where are the risks that are building in the market? One of the consequences of the post-GFC era has been to outsource economic policy to central banks who have relied on QE. Now, QE has stimulated asset prices but not activity, and so it's disproportionately benefited the wealthy. This has widened wealth differentials and manifested in the wave of populism we are seeing. At the end of 2017, the Fed began the process of shrinking its balance sheet and will continue on this path until December. So despite the dovish rhetoric coming out of central banks, their balance sheets have now contracted 3% over the last year. So liquidity is being sucked out of the system, and it's being led by the Fed. Now, pairing this with recent soft manufacturing and industrial production data coming out of the US, The question then becomes, are conditions already too tight in the US? Is the Fed making a policy error? We also remain concerned about the broad deterioration in corporate credit. The stock of outstanding debt is high in an absolute sense, but particularly it's this growth in non-investment grade credit, which is that light blue stack on the chart. Now that is a concern. Average leverage ratios are high relative to recent Goldilocks combinations of low interest rates, historically tight credit spreads, and elevated profit margins. Worryingly, the growth in lower quality debt has occurred in weaker businesses, which are increasingly under the threat of disruption. These companies have used a low interest rate environment to take on debt, but to buy back stock and pay dividends, rather than invest in their own businesses. So while the index may be up almost 20% from the bottom, we see many risks building. So on top of liquidity tightening and credit excesses, we also have trade wars, geopolitical instability in Europe, and a bubble in growth stocks. As humans, we reliably misjudge the likelihood and the impact of rare events. Now, as we can see from our Jenga tower, we won't be able to pinpoint the precise moment of collapse or where the pieces will ultimately land, but we can observe building instability. Now remember, the price action in the fourth quarter of 2018 is a reminder of what happens when these risks come back to the fore. And we've seen this again in the last few weeks as markets have responded to the escalation in trade. Tail risks are multiplying, and we think this means volatility is here to stay. This next slide shows us where the market is today, crowding into growth or quality at any price. So this blue line is a measure of the valuation of the most profitable stocks in the market relative to the least profitable. Now, as you can see, this quality bubble is now a 2 standard deviation event, and we are about to breach the previous extreme valuations from the tech bubble. The yellow line is a measure of the valuation of the cheapest stocks relative to the most expensive. So expensive stocks continue to trade at ever higher valuations as investors crowd into yesterday's winners, assuming that they will be tomorrow's winners. Now, while crowding can continue, when it ends, it will have a very volatile outcome, given the degree of concentration of investment. The heat map is another way of looking at crowding, but now at the sector level. The orange and red squares show those parts of the market that are expensive relative to their long-term history. These sectors are staples, software, and healthcare. These are big liquid defensives and they're global businesses. So the market is crowding here to avoid geopolitical risk, so to avoid being exposed to any one single macro. The blue squares are those parts of the market that are cheap relative to long-term history. They are domestic-facing businesses like banks, property, telcos, and retail. The outlier here, though, is the US. Domestic-facing businesses in the US are not only expensive relative to their own 20-year history, but trade at a premium relative to the same businesses listed in the rest of the world. So why is this the case? Well, the US has already stimulated. And secondly, concerns around disruption have already been priced into domestic-facing businesses in Europe and Asia, but not in the US. So we think it will be hard for the US to accelerate much from here. We've already had aggressive stimulus. The fiscal deficit is 3.5% of GDP. This is a level we would normally see in times of deep recession or war, not full employment. And the data is softening and financial conditions are tightening. Conversely, China is stimulating, and we are seeing the effects of this in a stabilization in the Chinese economy. But we aren't getting carried away here. We are watching the data very closely to see that policy continues to have traction on the ground. Europe can also benefit from a stabilization in China. And this is in the context of Europe already trading at very attractive levels. So we see that Europe can benefit from a catch-up trade. So with that as the backdrop, where do we go from here? So should investors continue to crowd into yesterday's winners and pay any price for growth and quality? So at Antipodes, we look for growth and quality, and we are adding it to our portfolio, but we are looking in the less obvious part of the market, or we look to buy it opportunistically. So let's talk about a few stocks. So we've added Facebook to the portfolio last December when the market became very concerned about regulation and a slowdown in advertising rates. Now, due to the work that we'd already done on Facebook, we could observe that this slowdown in growth rate was temporary as advertisers were shifting from the newsfeed format to the stories format. And we also believe that regulation lifts barriers to entry and provides a moat to Facebook's business. So we see a company which has a long runway to monetize its platforms via both advertising and e-commerce opportunities. And we added this stock to the portfolio and at less than 20 times earnings. So a very attractive price for growth and quality. Now, in this market's herding into growth, cyclical stocks have become incredibly cheap. And in fact, they're pricing in recessionary outcomes. So we have added cyclicals to the portfolio that have a structural growth story. So it's another way of adding cheap structural growth to the portfolio. Siemens is a good example here. The market views this business as a big, messy conglomerate. But it's slimming down its portfolio, upon which we believe almost half of Siemens' earnings will come from its digital factory business. Digital factory is the next wave of industrial evolution. It incorporates both hardware and software to fully digitize the production process, right from product concept all the way through to mass production. Hardware makes the plant run as efficiently as possible, and the software is the brains, which controls and optimizes the processes. Siemens is the only company that can provide a complete end-to-end integrated solution, but it trades at a significant discount to the pure plays because all the market can see is a big, messy conglomerate. We've also added to our software incumbent cluster with SAP. In the world we live in today, data is the competitive advantage. SAP, via its own product development and acquisitions, has transitioned itself from just a back-office ERP system to a software stack that offers customers insights right from the design of their product or service all the way through to feedback on the user experience, and feeds this user experience data back into the design of the company's product or service. So SAP's portfolio enables the complete digitization of the enterprise. And just like Microsoft and Cisco, SAP is the incumbent. And with that comes the advantage of scale and customer lock. Sony is another recent addition to the portfolio, a technology conglomerate that we've added at 9 times earnings. So there are 3 main parts to Sony's business. Firstly, it is the #1 player in high-end image sensors for cameras. So this is another structurally growing story. The handsets that we use now have front and rear cameras, and image requirements for cameras in handsets are going up, which means more image sensors per camera. There are very high technology barriers to entry in this business. Samsung Electronics is the #2 player in image sensors, but they only use Sony's sensors for all of their own high-end handsets. Secondly, Sony's music business is now growing thanks to the likes of Spotify and Apple Music. So for every $10 spent on Spotify, they have to give $7 back to the music label. And Sony is one of 3 labels, so they're getting their fair share of this. And finally, Sony is the dominant gaming console with the largest online streaming service. Sony has over 40 million subscribers paying a monthly fee. And as well as that, they take a 30% cut of any in-game downloads. So with that tour of the portfolio, we would like to open the call up to Q&A.
Thanks, Alison. So hopefully that's been informative, albeit brief, summary of where the portfolio is today, and some comments around the performance year to date especially. Please send us your questions via the webinar app and or via email, and we'd love to address them. While we're waiting for some questions to come through, let me just ask Alison one that a number of people have asked us already, and that is around our net exposure. So just to explain the context of the question, obviously on our long-short fund, we have a proportion of the fund invested in long positions, and then a proportion in short positions, giving a net exposure to the market that's somewhat less than 100%. It's been around about 60% plus or minus since inception of the strategy 3.5 years ago. It does vary through time, but clearly we don't target a specific net exposure. The question really is, why don't we significantly move that net exposure? For example, in the first quarter of this year, had we had a higher net exposure, then we would have caught more of the upside in that very strong market bounce. Have you had any thoughts on that question?
Yeah, thanks, Andrew. So, I mean, the first and most important point is we aren't targeting to a net. So the net is always going to be a function of the opportunities we see on the long side and the short side. So the net position did increase through the first quarter via adding to the longs and reducing the shorts. And so by March 2018, the net was around 66%, and it's dropped back since then as we've reduced long positions in this market rally. Now, with the benefit of hindsight, and Andrew touched on this earlier, yes, we should have gone longer in January. But at the time, when the market was responding to dovish commentary from the central banks, in the sense that the central banks stepped in to save the day, at the time, the tail risks which we were worried about in the fourth quarter, and ones that I mentioned in the presentation, like corporate credit, geopolitical instability, trade, none of these are resolved with dovish rhetoric from central banks. So, without trying to sound like an excuse, what we were concerned about in the fourth quarter, we were still concerned about in January. Having said that, we did learn some lessons for next time. So, with the depth of the research team, and Andrew touched on this earlier with the number of investment professionals we have, with the depth within the team now, we have the capacity to be more tactical with positioning. So we certainly aren't changing our investment philosophy or the way we research stocks, and we're never going to be market timers. That's not what you're going to get with this fund. But we do have a very experienced and deep research team. So the lesson learned is to just be a bit more agile with our positions. And we have sort of used some of these lessons in the market rally year to date. So we've taken a little bit of money off the table in April to capture the alpha in the longs, particularly in longs where we just haven't had the same level of conviction. And you can see that coming through in the April performance figures. So I think that, in terms of the two key takeaways, we aren't targeting to a net, but the lessons learned is we can be a bit more agile, and we are implementing. We certainly have done that in the last few months.
Okay. I'll just move to one of the questions that's come through, and it relates to our listed vehicles. So we have two ASX listed vehicles, one being a closed-end listed investment company with a ticker APL. The second listed vehicle is an active ETF, AGX1. So I'll address the listed investment company first, and the question is, can you talk to the underperformance of that vehicle? Now, when it comes to listed investment companies, it's important to firstly just mention the different ways of measuring performance. The underlying strategy of that vehicle is pari passu with the global long-short strategy. So the portfolio performance would be more or less identical to our unlisted funds, whether it be the PI fund or the Australian unit trusts. Being a company, there's a company level of performance or NTAs, the way to measure performance of a listed investment company, at the next level, and that includes any impact of capital management at the company level. So, for example, new share issues, buybacks, etc. In the case of our listed investment company, APL, at issue in 2016, there was a 1-for-1 option granted to IPO investors, and with an expiry date of 2 years post-listing. That was in October last year. Around 93% of those options were exercised, leading to a dilution in the NTA of the company. That amounted to around about 11 cents per share. Also, the company has made 2 dividend payments since inception. So that's one reason why, if you were to plot the performance of the NTA versus, say, the performance of a cumulative managed fund return stream, there's quite a divergence. It's primarily due to the dividend payments and the dilution courtesy of the options. Of course, if any investor was there at IPO, their actual return needs to factor in the value of those options, either the value accretion through owning additional shares upon exercise, or any value that was obtained through selling the option through time. There's some comments around APL itself, and then the third level, I suppose, is the share price performance. And clearly, with closed-end investment companies, they can trade at either a premium or discount through time. That reflects market sentiment, if you like, in a period of underperformance, and this goes for many global equity LICs. The average discount across the whole sector has trended down in recent times. By that I mean the last quarter or two, especially because here in Australia there was this looming change with franking credits, which I know is not that material or not relevant for many of you in New Zealand, but the franking credit overhang, should there have been a change of government here, certainly depressed prices of Australian listed investment companies. So that's one reason the discounts across the sector generally increased over the first quarter of this year. You've seen a bit of a bounce more recently, and we're sort of middle of the pack, if you like, in terms of where our discount currently sits. We've made a very firm statement to the market saying that the manager, being Antipodes Partners, individuals associated with the manager, so Jacob Mitchell as CIO and founder of Antipodes Partners, and others, some directors and others at Pinnacle, are really confident about the long-term success of that vehicle, and we've been buying shares in the recent period. We made an announcement to the ASX to that effect, and we now own over $5 million worth of shares collectively in APL. Switching to the ETF briefly, that's a newer vehicle that does trade at NAV, so there is no sort of premium discount issue with an active ETF. It's an open-ended structure, almost identical to a managed fund, albeit listed. There's some technicalities around how that works in practice, so if anyone's interested in that vehicle, please reach out to David Batty or to us directly here at Antipodes Partners. All right, I think we have got one other question, and that's in relation to shorts and protecting on the downside. And the question goes to, if we want to protect on the downside, why wouldn't we do market-wide or index shorts as opposed to stock-specific shorts? Is that not a better way to protect against downside? I'll let Alison answer first, and then I'll maybe add some additional comments.
The short answer is that we do use a combination of ways to short. So we actually do short indices, and we do have some tail risk hedges in there, which are index based, and we do stock specific shorts. So we do use a combination of all three. Now, with regards to the stock specific shorts, they will often form they work to manage risk within the cluster. So, and I think you can see now in the way that we are showing the cluster slide, which is on your screen now, we've got our shorts split in terms of the cluster so that you can see the net exposure in that cluster. So we do short individual stocks within a cluster to manage, as part of one of our tools for risk management within the context of the portfolio. And really that is a comment on, perhaps if we are wrong, we will pick it up on if we are wrong in our longs, we would pick it up on our shorts. So the individual shorts do act as risk management.
I'll just add that clearly if you're taking market-wide or index shorts, it's much more akin to market timing relative to taking shorts on individual stocks where you have idiosyncratic risk associated with individual companies. So it's not the case that an index or market-wide short is less risky than going individual shorts. We think it's a combination makes sense, and as always, market timing is a difficult game to play, and that's not our primary goal with shorting. All right, we've been about 30 minutes, so I think we'll close off the call now. Just in summary, I'd just like to point out that we have two global strategies available in pie format, the global long-short strategy and the global long-only strategy. Now, a lot of the questions we've had in recent times go to the long-short strategy and its lower net invested position and not keeping up with a very strong upward moving market. That is I guess an outcome, if you like, of the strategy's design, in that you're effectively paying some insurance by having shorts and a lower net invested position to take care to preserve capital in tougher times. And at the end of the day, over the long term, we expect that strategy to handsomely outperform the broader equity market, but do it with a smoother journey with lower volatility, hopefully over time. Now, for some clients, that may not be the best strategy for them. If people are somewhat less concerned about downside protection, more concerned with matching an index or beating an index through every stage of the cycle, then a long-only strategy has a better prospect of doing that. So it's really horses for courses. And if you look at those two strategies side by side, you can see the slides on screen now. It just shows the performance profile and the drawdown profile of each of those strategies through different periods. Just wanted to make that point in closing. David would, of course, be happy to meet with you in person and run you through in more detail how those two strategies can work in combination or may address different investors' needs. All right, with that, thank you very much for joining us on the call today. We look forward to meeting you in person in the not too distant future. And please, if you have any questions, don't hesitate to reach out to David Batty or send us an email here at Antipodes in Sydney. We look forward to speaking again soon. Thanks very much.